Hello everyone and welcome back to the channel. Today we are going to talk about one of the most important things when it comes to personal finances, and that is credit cards and credit score. Your credit score is important for so many things, like getting approved for a mortgage, car, even renting. Your credit score is based on so many things, so it's so important that you really work on building it. So today we're going to talk about how you do that. What exactly is your credit score? It's basically a grade that lenders and banks use to determine how risky you are when it comes to loaning out money. They use this grade to decide whether they will lend you out money or not, and also how much interest you're going to pay. If you have a lower credit score, you are now considered higher risk, meaning that you're probably going to pay a lot more interest than someone that has a higher credit score. Your credit score is based on a scale of 300 to 850, 300 being the lowest and 850 being the highest, which is where we want to get to if we can. Scores under 680 is usually when they'll either reject you or charge you extremely high interest, and that's extra money we don't want to be paying out. This is why it's so important to work on your credit now. Let's talk about the credit score breakdown so you can tell where it's all coming from and what's most important to least important and where you should make sure you're really focusing on. The biggest factor is 35%, and that is for on-time payments. So the most important thing about your credit score is when you are paying off your credit card. Are you carrying over a balance? Are you paying it off in time? This is so important because it shows how many late payments do you have? Are you paying a bunch of interest? Do you pay off your credit card? This is the most important thing, which is why you should always pay your credit card on time, which we'll also get into. At 30%, we have credit utilization, which is the amount of credit that you have versus the amount you're using. So if you have a credit card that is $1,000 and you use $1,000, you are using 100% of your credit card utilization. If you have $1,000 and you're using $300, that is 30%. They say you want to be about 30% and under, so make sure that you don't go above 30% of what your credit card limit is if you can, because this makes the biggest difference. If you're maxing out your credit cards, you are going to be more high risk than someone that's only using 30% or less. Coming in at 15% is the age of your credit score. So how long have you had an account open? How long have you had a credit card? How long is your credit history? Someone that's had a credit card for 1 year versus someone that's had a credit card for 10 years is going to make a big difference. That's why it's important to get a credit card as soon as you can, be really responsible, and keep building it because you're really going to want it down the road. And then coming in 10% is types of credit. That would be like your mortgage payment, your car payment, auto insurance, loans, because they want to see how can you handle different money. Your mortgage payment is different than like paying off your credit card. Like they look at it as you can handle different ways of money. You can handle that you can pay your mortgage, you can pay your car payments, you pay off your credit card. They want to see like a diversity that you're paying off everything. And your very last 10% goes to hard inquiries. Are you opening several credit cards? Are you putting in applications on something that requires a credit card check? Keep these things on a low because it can really bring down your credit score, especially when there's several in a short period of time. Now that you have a whole background on credit cards, the first step that you're going to take is you're going to go and you're going to download your credit card report and you're going to go through it. You can do this through many different websites, through your bank. Make sure you find somewhere secure to do this and do not pay for it. This is free information, so don't pay for free information. Take the time to go through it and refer back to all the things that we just discussed about the breakdown. The most common issues can be late payments, just not having enough credit card if you only opened your credit card recently, any collections on your files, and then maxing out your credit cards like we talked about utilization. So sit down, go through it, and see where the big problem is and where you really need to focus on working on. The first thing that you're going to go focus on is credit card history. Like we talked about, history is, and the age of your account is really important. If you don't have a credit card, go apply for a no annual fee one and start with a lower limit just to kind of dip your feet in. You definitely don't need a $10,000 credit card limit to start. Calculate how much you have for your credit limit and then calculate 30%. Like we talked about, if you have $1,000, 30% is $300. Like we said, we want to keep our utilization under 30%. So that would be under $300. So sit down, see how much you have, and if you have many different credit cards, figure out the total amount and then figure out how much your utilization amount is so that you're not going over it, because this will really help boost it up. Remove any late payments from your account if you can. If you have payments that you're not paying, go pay them off. It's better to pay something off 30 days late than it is 90 days late, and so on. Of course, we want to try to have no late payments, but if you do, clean them up. The longer it goes on, the worse it's going to get, and you're really going to drop your credit score, which we don't want. Another thing that you really should know is don't close any old accounts. Like we talked about, the age of your credit history is really important. So that's why you shouldn't close out any old accounts, because then you're erasing all that history. You know, if you have 2 years, 5 years, and then you close that account, you're erasing all that history that you want, because it shows that you've had credit history for longer. So either just don't use it, or maybe use it every so often, buy a coffee and pay it off to keep it active. Or if it's one that it does have an annual fee and it's not free, then contact them and see if you can switch to a free version of it so that you're not paying for a card you're not using. The best time to pay off your credit card is before the statement closing date. Not the due date, the statement closing date. So pay attention to that. And another thing is, remember, the more missed payments that you have, the more it's going to lower your credit score. Now, to wrap this all up, you're going to go apply for a no annual fee credit card if you don't already have one. Then you're going to pay all your payments on time, and you're also going to make sure that you're only using 30% of your credit card limit. So make sure you do that math and calculate that. You're also going to keep the account open so that you can make sure that you're getting years of credit card history, because you're going to want that. Remember, it's okay to have a few different types of credit history, from having, your mortgage payment, your credit card. I'm not saying go take out a bunch of loans, but so that you can show that you are in control of your card payment, your mortgage, to your credit card. And be careful not to apply to too many accounts, because you don't want too many hard inquiries. When you're placing an application on something, be mindful, because they might do a credit card check and you don't want too many to come up on your report. Aim for a credit score about 750 or higher so that you can get the best interest rates from banks, lenders, all the things. All I ask is that you like and subscribe so I can continue to give you this free information, and I really hope this helps. Have the best day.